Hello everyone and welcome to our YouTube channel Kautilya IBS Mumbai. Today we will be diving deep into the types of bonds available in the market. Treasury bonds. The central government issues treasury bonds, hence it is the safest type of bond because there is no credit risk. These bonds have a maturity period of 10 to 30 years and pay a fixed interest rate, which is a factor in the prevailing market conditions. Corporate bonds. Companies or business conglomerates issue corporate bonds to raise capital for their business operations. They are riskier than treasury bonds because the creditworthiness of the issuing company backs them. Corporate bonds can have varying maturities and interest rates depending on the issuer's creditworthiness and market conditions. Municipal bonds. Local and state governments use these to gather funds for development projects such as schools, highways, and hospitals. Municipal bonds are exempted from tax. They are available in both short-term and long-term maturity. High-yield bonds. Companies issue high-yield bonds with lower credit ratings and are riskier than investment-grade bonds. They offer a higher yield to compensate for the higher risk. High-yield bonds are also known as junk bonds. Mortgage-backed securities. Real estate companies create mortgage-backed securities by pooling many mortgages and issuing bonds against the underlying mortgage pool. The cash flow from the mortgage backs these securities, so they are safer than corporate bonds because they carry less credit risk. Floating rate bonds. Floating rate bonds have an interest rate adjusted periodically based on a reference rate such as RBI's repo rate. It protects investors from interest rate risk because the rates move with prevailing market rates. Zero coupon bonds are issued at a discount to their face value and do not pay periodic interest. Instead, they offer a fixed return at maturity, that is, the difference between the issue price and face value. They are ideal for investors who want to lock in a fixed return for a specific period. Callable bonds. The issuer can redeem callable bonds before maturity, usually at a premium price. They offer the issuer flexibility in managing their debt obligations but carry investment risk for the investors. Convertible bonds. The issuing company can convert these bonds into shares of the issuing company's stock at a predetermined conversion ratio. They offer the investor the potential for capital appreciation and fixed income. Inflation protected bonds. The government issues inflation protected bonds intending to protect investors from inflation. They pay a fixed interest rate which is adjusted periodically to reflect changes in the consumer price index. Now, let us have a look on the types of debt markets. The debt markets are divided into two broad categories. Primary debt market, which is the platform where newly created debt securities are first issued and sold to raise capital. In this market, governments and corporations initiate debt financing by selling shares, bonds, bills, and notes to investors. The primary market provides a platform for companies to generate funds to finance their operations, infrastructure development, and other projects. The Securities and Exchange Commission enforces strict rules in the primary markets to protect investors. Secondary market. Secondary market is also referred to as the resale market. In this market, investors buy and sell already issued debt securities. The price and yield of each bond are determined by the dynamics of the secondary market. Instead of acquiring securities directly from the issuer, investors procure them from other investors. Unlike the primary market where all the debt securities are sold at a fixed price, the secondary market's price depends on market demand and supply. If the demand for the bond increases, the price will go up, and if the supply increases, the price will go down. All the bonds are traded over the counter in the secondary market, which means that these debt securities are not listed on the stock exchange. Investors approach brokers to arrange a sale or purchase. The secondary market is considered more liquid than the primary market, and investors can easily enter or exit the market. Government securities, often referred to as G-Secs or govies, represent a crucial component of the stock market and play a pivotal role in the country's economy. The government securities, meaning, are debt instruments issued by the government to raise funds for various purposes, such as financing infrastructure projects, bridging budgetary gaps, or managing national debts. GSEC carries an assurance of complete repayment of the invested principal amount upon the security's maturity. In addition, certain government securities may offer periodic coupon or interest payments. If you like the content, do like, comment, share, and subscribe to our YouTube channel Kautilya IBS Mumbai.